So I told you we were going to talk about 3 different tax cuts in the United States, the 3 most recent ones. So we've already talked about the one that occurred in 1981. Let's talk about the other 2 that occurred before 2015. And it was the Tax Act of 2001 and the Tax Act of 2003. Let's dive into the 2001. So its official name was the Economic Growth and Tax Reform Reconciliation Act of 2001. This occurred under the Bush administration. So what did they do in this tax reform? Well, what they did first and foremost is they reduced the marginal tax rates on taxable income. So what they did is they actually lowered the top marginal rate from 39.6 to 35%. So remember, we talked about the United States is in a progressive tax structure, meaning the more you make, the more you get taxed over and above certain levels of income. So that highest in that top marginal rate, meaning if you surpassed a certain amount, every dollar beyond that, you got taxed 39.6% prior to 2001 and prior to this act. After that act, you got charged just 35%. So if you were making $1 million, any dollar over, say $1 million, you would get, the government would take 35 cents of it. And what you ought to do is you ought to go and look up what those progressive tax brackets are and see what they are and kind of see how it lines out, because we do face that progressive tax bracket. It also created a 10% income tax bracket for the first $6,000. So it created the lowest tax bracket and say for the first $6,000 of taxable income, you're just going to get charged just 10% of it. So it actually reduced that taxes. It created a brand new tax bracket on the bottom, and it reduced taxes actually for low-income families, as well as reduced taxes for high-income families by reducing this highest in top marginal rate from 39.6 to 35. So both of these were designed at reducing the tax rate. Well, then the Tax Act did a couple other things, and it was aimed at reducing your taxable income as well. So child exemptions actually rose from $500 to $700, and then by the year 2010, it's actually reached $1,000. Well, what does that mean? So say you're making $50,000 and you have 2 children, and say that $50,000 is your taxable income. Well, now you've got these 2 children and they both receive exemptions. So now all of a sudden, instead of paying taxable, or you're getting taxed at say $50,000, because of your 2 children at $1,000 a piece in terms of tax exemptions, now you're just getting a taxable income of $48,000. So now instead of paying tax on $50,000, you're paying tax on just $48,000, saving you taxes. The second aspect of how they reduce taxable income is they actually increased the allowable IRA contributions from $2,000 to $5,000. So what does that mean? Let's say that you're an individual and you're making $50,000, you got 2 kids, so you're now receiving $2,000 in tax exemptions for your 2 kids. And then on top of that, prior to, you were maxing out your IRA at $2,000, so now your taxable income is brought down from, say, $48,000 to $46,000. Well, now you could put another $3,000 in IRA contributions, reducing your taxable income by another $3,000. So if in the year 2010 it's reached that $1,000 tax exemption per child and $5,000, you're maxing out your IRA. And you have 2 kids, and now you're reducing your taxable income by $7,000 for those 2 kids, and that the amount that we're putting in the IRA. So your taxable income is now fallen from $50,000 to $43,000. That's reducing the amount of taxes that you're having to pay. Another thing that this Tax Act did of 2001 is it reduced the top death tax rate from 55 to 45%. So what is a death tax? I encourage you to go and look up the death tax as well, especially if you're going to be looking to possibly inherit a large amount of land at some point in time in an agricultural operation because of the asset value. So what is a death tax? Well, whenever somebody dies and they pass on their property, their assets, all of their estate onto the next level of individuals, maybe their kids, maybe an heir of some kind, those kids or those heirs, those people that are going to be inheriting that estate will have to pay taxes if that estate is worth over a certain amount. So prior to 2001, that exemption was set at $675,000. So if the deceased person basically gave their property, their assets to their heir, and it was less than $675,000, essentially they wouldn't have to pay taxes on it. The recipients of that would not have to pay taxes on it. But $650,000 or $675,000 was not a lot of money, especially as you start getting into bigger businesses and agricultural property and things of that nature. Well, during this Tax Act of 2001, they actually raised that minimum exemption to $3.5 million, which now means that for the first $3.5 million on an inherited estate is actually tax exempt. You're not going to have to pay taxes on it. If you start getting above that, then you're starting to have to pay taxes on it. And then on the top tax rate, they decreased it from 55 to 45%. Now I would encourage you to go and look up the death tax and the estate tax. It's basically the estate tax, but known as the death tax. Go and look it up because it has changed since 2001 and kind of see where it's at, especially if you're looking to inherit a large amount of wealth in the future at some point in time. Start looking at that now to be able to start doing some estate planning. So the tax cut, this particular tax cut of 2001 accounted for $75.8 billion in real terms. And it also decreased the federal budget deficit by 2.8% as a percent of the national income. So it actually reduced that budget deficit as a percent of national income. The idea behind it was meant to spur on the economy. So then the Job and Growth Tax Relief and Reconciliation Act of 2003. This also occurred under the Bush administration, and it was the third largest tax package in U.S. history. So what did it do? Well, it reduced the long-term capital gains tax from 15 to 10%. So what is long-term capital gains? Well, let's say you bought a piece of property at $1,000 an acre, and then 30 years later, you're looking to sell it, and now it's worth $2,000 or $3,000 or $4,000 an acre. Well, that's long-term capital gains because you have gained value on your assets. Essentially, capital gains is the value that you've gained on those assets. And if you went to sell that land, you'd have to pay taxes on that land or taxes on that asset that you're selling. And if it's worth more now, well, now you're going to have to pay more taxes on it. So, or the taxes on that gain, and they actually reduced it from 15 to 10%. It also capped the tax rate on dividend income at 15%. So what is dividend income? So if you invest in stocks in a business and that business makes a profit and they decide to actually pay out part of that profit to their stockholders, well, that's dividend. Those are monies paid to the stockholders, and that's known as a dividend. So you do get tax on those dividend earnings as well, or that money received as dividends. So they actually capped that dividend income tax rate at 15%. And what these two were designed to do is it was designed to boost income expenditures. So what it was designed to do was encourage you to take your income and buy investments with it. Place it in stocks that are going to earn you dividends, and it was designed to boost those income expenditures. It also reduced the top-end tax rate on taxable income from 35 to 33%. So up here we talked about it reducing that top marginal tax rate from 39.6 to 35. Well, they reduced it again down to 33%. So those were the three main tax cuts that we're going to talk about. But I also want to talk about what happened during the Great Recession. So the Great Recession occurred between 2007 and 2009 after the pop of the housing bubble. After the housing market crashed, we entered in what was known as the Great Recession. And because we were entering in that Great Recession and the economy was slowing down, we were in that recession. The U.S. government actually employed some expansionary fiscal policy actions. So I want to talk about some of those specific fiscal policy actions, specifically TARP. So what was TARP? Well, TARP was a discretionary government spending actions such as the Troubled Asset Relief Program. So the government actually went in there and started bailing out companies, bailing out businesses, large bailouts, and it was titled the Troubled Asset Recovery or Relief Program. So the federal government actually went in there and performed different governmental spending actions in order to spur on the economy. Well, under this TARP, they went in there and they basically provided money to the auto industry, the bank investments that were involving capital purchases and assets guarantee, and then the bailout to AIG for stabilization of AIG. All of that happened during the Great Recession to try and stabilize the economy from some of these very big players, some of these big banks, the auto industry, to kind of stabilize that. Something I would encourage you to do is actually go and watch the movie called The Big Short. The Big Short talks a lot about the housing market and kind of what happened, and it's a pretty interesting movie of what happened to actually cause the housing bubble to pop and what all kind of went on in that particular realm. So go and watch that if you ever get the chance. So something kind of an interesting takeaway from the Great Recession is that in 2001, the Congressional Budget Office projected a cumulative budget surplus of $5.9 trillion through 2011. So in 2001, they were actually predicting that we weren't going to be in a federal budget deficit. We were going to be in a surplus. We were able to start paying down our national debt. We were going to be able to start coming out of that debt back in 2001. That's what they predicted. And they thought that we were going to have a surplus of $5.9 trillion by 2011. Well, what really happened? Well, the government programs and the decline of the U.S. economy actually resulted in a $19 trillion deficit through 2015. So that's part of the reason why we're facing a $27 trillion deficit right now. A large part of it was actually due to the Great Recession and how bad it was during the Great Recession.